Hello to you passive income investors looking to generate yield through dividend stocks. In this video, I've got an interesting comparison. I'm going to answer which one is the better dividend stock to buy right now to generate passive income. Is it British American Tobacco or is it Coca-Cola? Now, these two both have decent dividend yields. BTI is going to have the much better dividend yield, as you'll see, but that's not the only determinant. So let's look at all the determinants I look at when I'm investing in a dividend stock and which one I think is the better dividend stock to buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so like I mentioned, British American Tobacco with a dividend yield of 9.56%, more than 3 times the rate of Coca-Cola, which offers investors a dividend yield of 3.07%. But remember, the dividend yield is only one component of your total return. If you're a dividend stock investor, you also have to consider the potential changes in the stock price. So that's why we're going to look at 4 additional factors when we're looking at a dividend stock to invest. So the next important thing I'm going to highlight is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. So now that you understand what that's about, let's consider the numbers. British American Tobacco with an earnings per share of $4.68 in the most recent trailing 12-month period. And going back longer term, you can see that the orange line, which is the earnings per share, has been above the purple line, which is the dividend per share. And most recently, there's a nearly $2 gap from $4.68 to $2.78. So British American Tobacco, strong dividend, not a unhealthy dividend yield. Coca-Cola, meanwhile, a little bit volatile. You can see the orange, which is its earnings per share, dipping below the purple, which is its dividend per share, briefly in 2018. Still, in recent years, its earnings per share has exceeded its dividend per share in the most recent trailing 12-month, $2.49 compared to $1.82 of its dividend per share. However, Coca-Cola has been increasing its dividend per share meaningfully and its earnings per share meaningfully in the last several years, while British American Tobacco has not demonstrated that level of dividend growth or earnings per share growth. Cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you understand the importance of cash flow from operations, you can see British American Tobacco at a 37% CFO to sales rate is in excess or ahead of Coca-Cola at 26.38%. British American Tobacco has been one of the most profitable companies in several years as it harvests its business and doesn't really invest in growing its existing business because people are decreasing the amount of cigarettes they smoke. British American Tobacco is trying to transition into non-combustibles, so it's in more of a transition rather than investment in growth. Coca-Cola, meanwhile, it's also harvesting its cash cow in its beverage business, always looking to make the business more profitable. Still, 26% versus 37%, British American Tobacco ahead in this metric. Revenue. Coca-Cola in trailing 12-month revenue exceeded British American Tobacco at $45 billion versus $34 billion. Now, when we're looking at organic revenue growth, meaning revenue growth from the core business, not from acquisitions and divestitures or mergers and acquisitions, I feel Coca-Cola has much stronger prospects over the next decade versus British American Tobacco. As I mentioned earlier, cigarette consumption is decreasing as government regulation is increasing, government restriction, taxes. The government is really trying to decrease cigarette smoking. That's going to be difficult for British American Tobacco. As much as it transitions and it focuses on international segments, still it's going to be a challenge for British American Tobacco to increase revenue. it's going to take everything it has to not experience decreasing revenue. Coca-Cola, meanwhile, is benefiting from the away from home trend. Consumers eating out more often, going to restaurants, bars, theme parks, movie theaters, all areas where Coca-Cola has stronger market share than its rivals, PepsiCo and others. And that's been a boom to Coca-Cola, I should say. And you can see its revenue booming in recent years. I suspect that will continue over the next 2 years at the very least, perhaps even longer. So in terms of revenue prospects, Coca-Cola significantly better than British American Tobacco. And finally, I wanted to look at valuation, and I chose to use the forward price to earnings ratio. And according to this metric, Coca-Cola is nearly 3 times as expensive as British American Tobacco, trading at a forward PE of 19.99 or 19.99, and against British American Tobacco at 6.474. Now, if I was a dividend stock investor and I was looking at these two dividend stocks, I would pick Coca-Cola. I think there is less risk with Coca-Cola, and so the risk-adjusted return, I think, will be better with Coca-Cola stock over the next several years, perhaps even the next decade or more, versus British American Tobacco, which I also recommend as a buy, although I don't like British American Tobacco stock as much as I like Coca-Cola stock. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.